One stock that is considered one of the safest, one of the most predictable dividend-paying stocks out there is Johnson & Johnson, stock ticker JNJ, and they're currently trading $154.08 per share. Now, not too long ago, they were actually trading right at their 52-week low of about $143 per share, but they recently released their latest quarter's earnings report, which we will jump into, and we've seen the share price jump up a bit over the past month. Because of that, they're up close to around 4% right now. Now, why is this stock loved by investors who love stability? Well, there's a few different reasons. Now, the first thing is something I actually pointed out on Twitter just the other day. Obviously, a company's credit rating can give great insight into the probability of bankruptcy over the next 30 years. And at the moment, there are only two different stocks with a AAA credit rating, and that is Microsoft and Johnson & Johnson. And you can see a AAA credit rating is the highest you can receive. And this means a 30-year bankruptcy probability is very, very low, far below 1%. And to put this into perspective, that's even better than the United States credit rating. So that's obviously one of the big reasons investors who love predictability and stability love this company, but the other is the dividend. This company is a dividend king. They've been increasing dividends for over 50 consecutive years. And in fact, if we jump over to my dividend breakdown sheet, and like always, you can download any of my spreadsheets and also get access to the ticker data add-on over on tickerdata.com, link in the description. But if we come up here and plug in JNJ and hit enter, all this data will load in. Now, right now, we can see the starting dividend yield is pretty decent, sitting at about 3.22%. But again, that dividend growth history is what's so impressive, over 50 consecutive years. And if we look at the past decade alone, we can see those dividend payments have gone from about $2.59 all the way up to now $4.70 in 2023, and now sitting at $4.96. So 50 consecutive years of dividend payments with a 10-year dividend CAGR of about 6%. So the dividend growth isn't necessarily remarkably high, but it has been very steady, very predictable, and very, very consistent during this time period. And what's also pretty nice is the payout ratios have remained in a healthy range as well. If we look at the free cash flow versus dividends paid out, we can see every single year for the past decade, free cash flow has been covering those dividend payments. And for example, in 2023, we can see free cash flow came in at about $18.2 billion, while dividends paid out was sitting at about $11.77 billion. And this did lead to a free cash flow payout ratio of about 64.5%. And for the most part over the past decade, they have had a free cash flow payout ratio of below 60%, but the past couple of years have been higher at about 68% in 2022, and like I just said, 2023, 64.5%. So the past few years have been a little bit higher, but again, dividend payments are still easily covered by free cash flow. Now, you can understand a lot about a company and their future plans for dividends when you look at their capital allocation plan, which is actually something Johnson & Johnson talked about in their recent earnings presentation. So if we go ahead and jump over to the presentation and look at the 16th slide, we can see the capital allocation breakdown here. We can see higher priority up here on top and lower priority down here on bottom. Now, the highest priority for this company is organic growth of business needs. Now, why is this important and why is this the top priority? Well, you have to understand, Johnson & Johnson is a healthcare company, predominantly in pharmaceuticals. So what this means is this company has to invest heavily into research and development, into their product pipeline, in order to continue to grow at a healthy rate. So the end result of them reinvesting back into the business organically is the years following they'll have more free cash flow. So a lot of the company's capital is going into areas like oncology, immunology, and neuroscience. And if we scroll down, we can see Johnson & Johnson is looking to double its neuroscience sales by 2030. Again, in order to grow all these business segments, they have to invest heavily into research and development to build their product pipeline. If the product pipeline were to really slow down for Johnson & Johnson, we'd probably see pretty slow earnings growth. Now, after the pipeline, we can see some other focuses for the company. First off is competitive dividends. This has obviously been a huge focus for the company for quite some time, and we can see in Q2 of 2024. They paid out $3 billion in dividends to shareholders and $5.9 billion year to date. Compare this to research and development, that came in at $3.4 billion and $7 billion year to date. So again, this is a higher priority than paying out dividends. But then we can see they also have investment into mergers and acquisitions, and they've also been buying back some shares, but this really isn't a huge focus for the company. We can see they've deployed in strategic inorganic growth opportunities about $17 billion. So that means investment in mergers and acquisitions. And for example, we can see very recently, Johnson & Johnson announced they were going to acquire Shockwave Medical for a total enterprise value of $13.1 billion just a few months ago, April 5th, 2024. And Johnson & Johnson's goal with this acquisition is to potentially become a leading player in the high-growth cardiovascular market. So again, this is just another way to grow their product pipeline. Now, before we go any further, let's actually talk about the recent quarter's earnings report for a moment. We can see Q2 non-GAAP earnings per share came in at $2.82, which was a beat by around 12 cents, and revenue came in at $22.4 billion, which was up 4.3% year over year and was a beat by around $60 million. So pretty decent results compared to analyst expectations, But here's what's also a little interesting in my perspective. If we jump over to earnings on Seeking Alpha and scroll down, we can see they've now beat their last 4 quarterly expectations. Every single quarter for the past year, they have beat analyst expectations. It's a pretty good track record. Now, that being said, there is still some bad news on the horizon for Johnson & Johnson, and most people are aware of this, but I don't see it talked about nearly enough because it puts a lot of uncertainty on the company right now, and that's the lawsuits they're going through right now, and this has proven to be pretty expensive so far. Now, as of right now, they haven't had to pay out a lot due to the lawsuits, but analysts are expecting in total lawsuits over the next decade to come up to around 10 to 15 billion. So let's put this into perspective. If we jump over to the company's balance sheet breakdown, again, one of my spreadsheets, we'll come up here, plug in JNJ and hit enter. We can see all this data will load in. Now, like I said, analysts are expecting over 10 to 15 billion in payments due to the lawsuits over the next decade. But we can see right now, Johnson & Johnson's total current assets sitting close to about 53.5 billion. This is as of the end of 2023. So the company actually looks like it's in pretty good shape. And maybe this won't be as big of a deal as some people think. Now, it's still a lot of money, but the company can handle this. This won't be detrimental. If we look at where the company ended with their cash and cash equivalents as of the end of 2023, this was sitting at about 21.8 billion. So they still have a lot of liquid assets on hand right now. Now, to be fair, this may slow the dividend growth just a little bit over the next decade, but overall, I don't think this is anything that the company can't handle. Now, with all this being said, is Johnson & Johnson trading at a good price at $154.31? And to answer that question, let's go ahead and jump into my stock valuation spreadsheets. Come up here, plug in JNJ, and all this data will load in. Now, again, like I mentioned earlier, investors love this company because of the predictability and the stability, and we can see this reflected in the company's beta. Very low beta sitting at 0.52, so you should see very low levels of volatility with this company, which a lot of dividend investors kind of like if they're closer to retirement years. Now, the first valuation we'll look at is going to be our discounted cash flow analysis. If we go ahead and zoom in, you can see in this scenario, we're assuming a free cash flow growth rate moving forward of 5.5%. So we project out to the future free cash flows of the company, find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, subtract out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of $163.19. If we look at our dividend discount model, you can see in this scenario, if we assume a dividend growth rate of 4.5%. Now, keep in mind, like I mentioned earlier, dividend growth rate over the past 10 years closer to 6% in 5 years, 5.75%. It could be a little bit lower moving forward, but I still think it'll be close to about 4.5% overall. So with all that being said, we come to a dividend discount model price per share of $148.09. So when we jump over to our output tab, we can see the two valuations that we used averaged together give us an intrinsic value of $155.64, which is actually very close to the current trading price for this company. Looks like it's just slightly off, maybe about 1%. So with a 10% margin of safety, you can see we come to an acceptable buy price of about $140.08 per share, which is actually pretty close to what the stock was trading at when it was right at its 52-week low. So whether or not you should buy Johnson & Johnson probably depends on the goals for your portfolio. I think this could be a good opportunity for some people, but for some people, you might want to look to other areas with better dividend growth opportunities. If you're someone closer to retirement age looking for a nice starting dividend yield with very predictable dividend growth moving forward and a very solid business model, Johnson & Johnson could be a really good option. But there probably are better dividend growth options out there. So with all that being said, go ahead and let me know what you think of Johnson & Johnson stock in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to a channel.